You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. What a holiday week. Very rarely do you get a lot of activity on the Friday after Thanksgiving, but on very high volume, we had the start of a downturn. And we are taping Options Playbook Radio. It is now December 1st. The markets are closed. And what a day we had today in the marketplace. We had a breakdown in the S&P 500 index, technically, overall. We had it closed today at $4,513.04. It was down 53.96. That implies that the Dow was down about 461. But more importantly, we broke through a level of support to the marketplace on the downside. The VIX has been spiking. We currently see the VIX close today at 31.12. It was up $3.93. But more importantly, we're above 30 on the VIX. When the VIX was hanging around the 25 level, it was being persnickety in that level. And before you know it, you close your eyes and you turn around and you see that the market is now at 31.12. So when volatility goes up, the one strategy that I like to look at a little bit, and we've done this a lot around earnings because when volatility is high, butterflies are cheap. So the one underlying that I like to do butterflies in when volatility is high is the SPX, the S&P 500 index. And this will be the first time on Options Playbook Radio, but we're going to get a little crazy, a little nutty. We're going to buy a couple of lottery tickets in the S&P 500 index. The markets are closed, and the SPX is a little tough when the markets are closed. They get a little bit wide after market, and while they're still trading. And so you get a little bit wider bid-ask spreads than you normally would on just an underlying stock. But with that said, we're going to use these markets with the market in the SPX at 45.13, and we're going to go out of the money on the put side, on the butterfly, with the VIX at 31, and we're going to go out of the money on the call side, and we're going to hope for a movement. This is a kind of a SPX version of a long straddle. This would be like the only way that I would probably do a long straddle in the SPX, in an odd way, because if we went and just bought the long straddle on the shortest expiration, which is this Friday, December 3rd, with the VIX once again above 30, The most at the money long straddle is trading for, at the midpoint, $87.50. So that makes at the money put and at the money calls right around $43, $44. And for 2 days worth of premium, that is extremely expensive. And so I really would not want to put down $8,750 to speculate on a fairly decent move in the SPX before this Friday expiration. Now, the option contracts that I'm looking at are weekly options, and that's worth noting in the SPX because there's a lot of different flavors of options: American style, European style. Some expire on the open on Friday. The European style ones do. The American style option contracts expire on the close, or the settlement is determined, I should say, on the close on Friday as opposed to on the open. And these ones are the weeklies. So they're the most normal if you normally trade stock options. And it is very important in the SPX to make note of that, because I've had a lot of people that have ran into a situation where they thought they were trading the option contracts that stopped trading on Friday and the close, and they weren't. Just that simple overall. All right. So looking at the weekly contract in the SPX, we're going to go out of the money to the downside. And on the put side, the butterfly is actually cheaper because of the volatility skew. The higher the implied volatility, the cheaper the butterfly is going to be to start with. If you're correct on your forecast on a butterfly, you want the middle strike, the option strike that you sold, to decay. Why? Because if you're correct in your forecast, that means the option contract that would be a home run on the trade needs time decay. It needs implied volatility to come down. It needs, or it needs expiration to approach. So in our instance, on the put side, if we're doing this butterfly, and I would enter this as two trades. I'd do one on the call side, one on the put side, but I would want to do it very quickly, or basically at the same time, if you will. And I am going to be buying to open the 44.60 put, selling to open the 44.40 put, and then buying to open the 44.20 put. Nice round numbers there, but that's a 20-point wide butterfly. Gives you a landing space of about 40 points, and we're going to start the closest to the money put option is about 50 points away from where the index is right now. And guess what? The market was down 54 points, if I round up a little bit, in the SPX today. So obviously a viable move. It made that move today. You're going to have 2 days until that expiration date, December 3rd. If you're going to be correct on your forecast, you would want to be correct closer to the close because of the things that we just mentioned. And the midpoint on this butterfly right now is showing 90 cents. That means for this lottery ticket, this 1x2x1 butterfly, we would enter it as a net debit to the account of 90 cents, risking $90. The maximum upside of the trade would be $2,000. That would be 20 points wide on the butterfly spread. But now you don't want to have that type of expectation, because that would mean it would have to stop right at expiration, right at 44.40 on the put side. Now, as I mentioned, the puts are a little bit cheaper. Looking for about you're going from 45.13 to get down to where this put would be, or this butterfly would be coming into money, would be 44.60. All right, that's the type of move you're looking for. I would also consider doing a call butterfly with this. In other words, I'm just betting that the market's going to move over the next 2 days in some direction. We have a lot of premium, and the butterflies are fairly cheap, so maybe we can do this. If we look to the upside, we're going to go a little bit further out of the money, because on the call side, the volatilities are not quite the same. They don't have that volatility premium that the puts do in a down market. So if we go a little bit further out of the money, we can get it done for a little bit cheaper, but we're going to still go 20 points wide. So I picked the 4,600 strike just because this is a podcast and it's just easier to visualize. But that's going to be the strike that we sell on the call side. So we're looking to buy to open the 4,580 strike call, sell 2 of the 4,600 strike calls, and buy 1 of the 4,620 strike calls. Now, the midpoint it's showing right now on this butterfly with the December 3rd expiration, the same expiration, is $1.50. So $150 to do that butterfly. We're a little bit further out of the money. The market's at 45.13. The closest to the money option contract is 45.80. So on the upside, we would like it to come back a little quicker, or a little further, I should say. But the total cost of both butterflies to do this trade, then on both sides, we have a 40-point landing area, if you will, that we would like the market to be in on the Friday expiration. And that is going to be $2.40 or $240. Now, if I did this trade, I guess I would be, you're looking at it as a very, very poor man's version of a strangle where we buy 2 out of the money option contracts. But just to let you know, like the strikes that we are looking at, the short strike of the 44.40 put is trading on the ask for $20. The strike of the 4,600 call is trading on the ask of $9.90. So a much more frugal way to take some exposure if you think the volatility will continue before the close on Friday. Now, one of my big concerns of doing this butterfly overall is that the market just moves too fast towards that strike. We really would like it to occur or land within the strikes on the Friday on December 3rd before the close of trading. That will give us the most bang for our buck, because whenever you're doing these butterflies, the reason why I'm even interested in doing a butterfly or a double butterfly is that high implied volatility helps out with butterflies overall, because you're going to be selling 2 of those option contracts to try to pay for 2 more option contracts overall. And so in this instance, just a very interesting scenario. Never talked about a double butterfly. This would be one time I would consider it. And as always, it's not meant to be a recommendation, but one of the things we always look for on Options Playbook Radio is we have over 40 different strategies in the playbook. We want to look for different scenarios where those strategies might apply. We're not trying to do a trading system. We're just trying to come up with different ways to use all the strategies inside the Options Playbook. And with the VIX right now at 31.12, this would be a way that I would consider doing in the SPX. And this is one of the only times that I would really consider it. Now, a lot of concerns in the marketplace overall, but it's a very short near-term trade, obviously a purely speculative trade overall. But I'll go through the strike prices one more time on each side, and then we'll call it a day. The last trade in the S&P 500 index today on Wednesday, December 1st, was 4513.04. On the put side, December 3rd expiration, buying 1 of the 4460 puts, selling 2 of the 4440 puts, and buying 1 of the 4420 puts. Net debit of 90 cents to the account. On the call side, buying 1 of the 4580 calls, selling 2 of the 4,600 calls, and then buying 1 of the 4,620 calls. Trying to peg a area that the SPX could land in by Friday. And this will be fun. This trade will be all said and done. I'll be watching the markets on Friday, and we'll see how we did next week in next week's podcast. So thanks for coming, everyone. That's it for this episode of Options Playbook Radio. But wait, don't run just yet. Want to let you know that we are doing a very basic options seminar on the Ally YouTube channel called Options for Rookies. I've already done 2 of the events today. We did the first one. It's on demand on the Ally YouTube channel. The session 101 was the basics. Just finished up today, session 201, the mechanics. And tomorrow at 2:30 p.m. Eastern Time, we'll be doing session 301, the strategies. Very basic strategies overall. If you have friends that might be interested, please send them to ally.com, options for rookies. Ally.com, options for rookies. You can also find that link in my Twitter. My handle is very simple. It's at my name, at Brian Overby. And I'll be tweeting out a link tomorrow if you are interested. So thanks for coming, everyone. And may all the options that you bought finish into money, and all the ones that you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.